All right, let's dive right into this explainer and treat United's second quarter 2026 earnings report not as your standard news recap, but as a high-stakes financial mystery. If you've been following the travel sector, you already know the mainstream headlines are usually dominated by weather disruptions and completely packed planes. But for an investor, what's happening beneath the surface is a much more fascinating story. We're going to look closely at the numbers today, more specifically, the glaring contradictions in those numbers. Is United Airlines actually becoming a fundamentally stronger business, or is all this booming consumer demand simply masking a really fragile profit equation?
Staring us right in the face here is just this massive paradox. United is growing its top-line revenue incredibly aggressively. Total operating revenue for the quarter jumped 16% year over year. But then on the flip side, its adjusted earnings per share essentially collapsed by nearly half, falling from $3.87 all the way down to just $1.99. That is a 48.6% decline. In the financial world, you almost never see top-line growth that strong paired with a profit drop that severe unless something huge is going on behind the scenes.
So we have to investigate this critical question. Where did the profit actually go? Think about it. How can an airline successfully raise its full-year 2026 earnings guidance to between $9 and $11 per share, which signals immense confidence, while simultaneously losing so much of its profit cushion in a single quarter? It totally doesn't add up at first glance. To solve this, we really have to look past the top-line revenue and examine the very real, very heavy costs of keeping these massive aircraft in the sky.
Well, our prime suspect in this missing profit case is a staggering number, $6 billion. To put that into perspective, that's literally like buying 50 brand new Boeing 737s just to watch the cash go up in smoke. It's the expected increase in fuel costs for 2026 compared to what management initially expected at the beginning of the year. United doesn't control the price of oil, it doesn't control refinery economics, and it certainly doesn't control geopolitical shocks. This single line item is just violently attacking the economics of the airline's recent revenue growth.
And this shock to the system? It happened almost overnight. Fuel expenses skyrocketed an incredible 84.1% in just the second quarter alone, jumping from roughly $2.7 billion in Q2 2025 to over $5.1 billion in Q2 2026. This isn't a gradual headwind we're talking about. This is a massive, immediate wall of expense slamming into the income statement all at once.
So how do you outrun inflation like that? Well, management is banking heavily on pricing power. CEO Scott Kirby's strategy relies entirely on the fact that consumers are still willing to absorb higher ticket prices. United actually managed to recover about half of that fuel cost increase in Q2 through pricing actions, and they fully expect to recover 100% by Q4. But, that hinges completely on the customer's willingness to keep swiping their cards for more expensive tickets. Interestingly, though, while overall U.S. airfares were up significantly, Kirby noted that inflation-adjusted fares actually remained about 13% below pre-pandemic levels. So maybe there's still some runway left for price hikes.
Let's peel back a layer here, because this is where the analysis really separates the novices from the pros. Unlike a beginner who just sees full planes and thinks business is booming, an experienced investor knows that United operates a highly capital-intensive network. Airlines can't simply flip a switch and turn off their massive fixed costs when oil prices spike. Planes cost billions, labor is incredibly expensive, and maintenance absolutely does not take a holiday just because jet fuel is suddenly breaking the bank.
When you look under the hood, you see exactly what capital-intensive really means in practice. Yes, they have fantastic liquidity, over $16 billion in cash and short-term investments. But look at the financial anchors dragging them down. They are weighed down by roughly $33.7 billion in total debt, finance leases, and operating leases. For us as investors, this means they constantly need a massive profit buffer just to keep the whole machine running smoothly. The planes exist, the debt exists, and the leases are due no matter what.
So the really crucial point here is that since those massive fixed costs aren't going anywhere, the sudden fuel shock just crushed United's profit margin. Their adjusted operating margin fell by a severe 6.2 percentage points, dropping down to just 5.4%. The revenue is growing, sure, but the margin cushion, the actual money they get to keep, is shrinking. This right here, this is the exact tension that makes airline investing so incredibly tricky.
Section 2. The Secret Weapons. Why Management Remains Confident. So, what's driving all this confidence? They aren't just crossing their fingers and hoping for the best. They are seeing incredible demand across the board. This rapid-fire growth across every single cabin and sector proves that United isn't just leaning on cheap seats. They are seeing amazing demand for their premium products, which grew 16%, in freight cargo, which jumped an impressive 23%. This shows they're building a network where passengers are choosing them for the schedule and the reliability, not just the cheapest ticket. And these premium segments are economically way more valuable when you're trying to offset soaring costs.
But honestly, their ultimate secret weapon is Mileage Plus, their loyalty ecosystem. With over 130 million members, this allows them to monetize credit cards and customer relationships long after the airplane actually lands. An airline seat is highly perishable, right? Once that door closes, an empty seat is worth zero. But a loyalty relationship, that generates continuous, high-margin revenue. It's basically a massive economic engine running right alongside the physical airplanes.
Plus, when you run a cash flow test, it shows this airline is an absolute machine at generating liquidity. In the first half of 2026, they generated over $6.4 billion in operating cash flow. That handily covered their $3 billion in capital expenditures. This means they're funding new aircraft and those massive Starlink Wi-Fi upgrades internally without immediately breaking the bank or having to take on crippling debt in a high-cost environment.
However, capital allocation always reveals the stark reality of the boardroom. Just look at the sharp drop in stock buybacks, plummeting from $589 million down to a measly $27 million. That is a huge signal. Management is aggressively prioritizing liquidity. With fuel costs spiking by billions, they're choosing to hoard cash to defend the balance sheet against those rising costs and service their debt obligations rather than propping up the stock price through repurchases.
All right, moving on to the valuation trap and the recession test.
Now, what happens if the economy actually takes a hit? If you're buying United, you have to understand you're betting against a brutal operating leverage trap. Because of those huge fixed obligations we just talked about, even a tiny drop in revenue, say just 5%, doesn't mean a 5% drop in earnings. It wipes out profits exponentially faster because the heavy costs of the aircraft, the debt, and the labor remain exactly the same. Operating leverage is beautiful when times are good, but man, it reverses viciously when revenue stalls.
Mapping out the future, it becomes super clear that a great company can still be a terrible stock if you pay the wrong price. In the bull case, fares rise and fuel stabilizes, margins recover, and the stock soars. But in the bear case, if fares stall because the consumer is tapped out and capacity creates excess supply while fuel remains expensive, those margins stay compressed, and the stock can tank rapidly even if United remains a dominant global airline. It's all about the expectations already baked into that share price.
So, summarizing the evidence on our investor scorecard, United boasts strong business quality, incredible demand growth, and massive cash flow generation. But it's carrying the heavy burden of squeezed profitability under intense fuel pressure and a mixed balance sheet loaded with significant financial liabilities. What this means for you as an investor is that with no major dividend play here, you are betting entirely on earnings growth and balance sheet improvement going forward.
Which brings us to the final verdict: watch or selective buy. So, what is the ultimate takeaway here? This definitely isn't a simple buy or sell. Because your margin of safety depends entirely on management's ability to offset billions in fuel costs, this stock requires extreme patience. The real mystery isn't whether people will keep flying. They absolutely will. The critical question is, how much money can United actually keep from every single flight? If margins stay trapped at 5% while revenue grows, what happens to the stock when capacity outpaces demand? Keep a close eye on those margins, and we'll dive into the hidden capacity numbers in our next explainer.